Hello viewers, welcome to my channel. I'm Hasham Ali Khan. We have started unit number 2 in accounting for management subject. Last video I have completed the distinction between capital expenditure and revenue expenditure, which is very necessary to make the financial statement. So without having the knowledge about capital expenditure, revenue expenditure, we cannot make the profit and loss statement or balance sheet. That's why I have explained you in detail regarding the meaning and also the differences between capital and revenue. In this video, I'm going to explain you the next topic, very important topic, very frequently asked in examination, that is depreciation. What is the meaning of the term depreciation? What are the objectives of providing depreciation? What are the causes of depreciation? And what are the factors to be considered for calculating depreciation? Lastly, what are the methods of calculating depreciation? These are the things I'm going to explain you very frequently in examination. Most of the examination, they will ask a theory question on this. So watch the video till the end. Before proceeding further, take the screenshot of the points which I have written on the board, then I'll explain. Now, first of all, I'll explain you about the meaning of the term depreciation. Depreciation is the decrease in the value of fixed asset due to wear and tear, lapse of time, obsolescence, inadequacy, etc. Every business will use non-current assets, fixed assets, like plant and machinery, equipment, furniture, building, motor vehicle. These are all the fixed assets. By using the fixed asset every year, the value of the fixed asset will decrease. That decrease in the value of the fixed asset over a period of time is called depreciation. So depreciation is also one of the expense, but it is a non-cash expense. We have to provide a depreciation by passing an entry. No cash is involved in depreciation. That is the difference. Now, the process of spreading the cost of fixed assets over its estimated life is called depreciation. First of all, very clear meaning, the cost of the asset is spreaded over its estimated life. For example, the machine cost rupees 1 lakh and estimated life of the machine is 10 years. So we have to spread 1 lakh rupees over a period of 10 years. So every year a part of 1 lakh will be known as depreciation and will be a charge against profits. Now, depreciation is a decrease in the value of the asset due to wear and tear. Wear and tear means usage. When we use any asset, its value will decrease. That is called depreciation. The cost of investment in fixed asset must be equitably allocated to different periods of their economic life in a systematic and a rational manner. Whatever cost we have incurred in purchasing the fixed asset, that cost of the fixed asset should be spreaded, divided over the estimated life of the asset in a systematic and a rational manner. Not arbitrarily. There should be some logic in spreading the cost. Next, the amount charged to each period is called depreciation and represent the cost of expiration of such asset. So every year a part of the cost of the asset is written off as depreciation. That shows the expiration, part of the expiration of the cost of the asset. Depreciation is thus the part of the asset of the fixed asset consumed during its period of use by the firm. It is that part of the cost of the asset which is used. For example, 1 lakh rupees is the cost of the machine. During the first year, 10,000 rupees depreciation we have charged. What does it mean? Out of the total 1 lakh rupees cost of the asset, 10,000 rupees are consumed during the current year because of depreciation. Now, depreciation is therefore an expense and will be need to charge into profit and loss account before calculating profit. So just like all cash expenses, like salary paid, rent paid, telephone bill, electricity bill, so many expenses are there, and this depreciation is also one of the expense. And it will be charged along with other expenses to find out the profit. So without providing depreciation, if you calculate profit, the profit is not true, because depreciation is also one of the expense that should be charged. So this is the meaning of the term depreciation. Now, what are the objectives? Why depreciation is to be provided? What are the objectives? First one, to ascertain the true profit. Without calculating, without charging depreciation, if you calculate profit, the profit is not true. So definitely we have to provide depreciation, then only we can get the true profit, correct profit, proper profit. Then to show the asset at its reasonable value, all the assets will be shown in the balance sheet. The balance sheet should show the true and fair view of the business. Correct financial position should be shown by the balance sheet. Assets should be recorded at its true value, not the original value. For example, we have purchased the asset for rupees 1 lakh. Every year we are using the value of the asset, but it is not depreciated. Then balance sheet, the value of the asset is showing 1 lakh. But is it true value? No. Because by using the machinery, its value has decreased. We have not provided depreciation. So balance sheet will not show the true and fair view. So it is compulsory to provide depreciation to get the correct profit and also to show the correct value of the asset in the balance sheet. Thirdly, although depreciation is not a cash cost, it is permitted to be deducted from profit for tax purposes. Every country we have tax laws. So according to the taxation law, the depreciation can be charged against profit. By charging depreciation against profit, what will happen? Profit will come down. When profit is reduced, our tax liability will also be reduced. Normally in most of the business houses, the tax liability is at the rate of 50%. Heavy rate of tax is there on the business income. So if we charge depreciation, then our profit will come down. When profit reduces, our tax liability will also get reduced. Third, last one, when depreciation is provided, it reduces the profit. And this saves the cash resources of the concern from being distributed by way of dividend. A joint stock company has to pay dividend from the profits. If the company is having more profits, more dividend has to be paid. If the company is having less profit, less dividend. So by charging depreciation, the profit will be less. When profit is less, the dividend payment will be less so that the cash resources can be saved. Otherwise, if profit is more, the company will pay more dividend, cash resources will go away, working capital problem, cash shortage problem will arise in the business. So these are the reasons, objectives why we have to provide the depreciation. Next one, causes of depreciation. Why depreciation occur? The first reason is wear and tear. Wear and tear means usage. By continuously using the fixed assets, its value will get reduced due to usage. That is called wear and tear. So wear and tear is the main reason for providing depreciation, main cause. Secondly, obsolescence. Obsolescence means outdated. Due to advancement in the technology, due to dynamic situation, the fixed assets may become outdated because advanced technology asset will come in the market. In that case, the old asset will become outdated. So to combat this situation, we have to provide depreciation due to obsolescence. Then inadequacy. When we purchased a fixed asset, we will purchase according to the current conditions. But as the business grow, that means the fixed asset will not be sufficient, will be inadequate. We have to replace the fixed asset by a higher level asset, capacity asset. In that case, whatever lower capacity asset we have purchased earlier will become outdated, inadequate. Next one is afflection of time. There are some assets whose value will get reduced by passing of time, even if it is not used. Even if it is not used, by passing of time, its value will get decreased. So due to afflection of time, passage of time, we have to provide depreciation. Lastly, depletion. Depletion means exhaustion. Normally, depletion will be applied in case of wasting assets, the natural resources. Many natural resources are there in the earth. So these natural resources are extracted like oil, coal, minerals, then stones. All these things are there beneath the earth. So there are many businesses which extracts these resources, and there we apply depletion. So these are some of the causes of providing depreciation. So what I have explained, meaning of the term depreciation, objectives and causes. Now what are the factors to be considered for calculating depreciation? Three factors we have to consider. First, the cost of the asset. Secondly, estimated residual value. Residual value means at the expiry of the life of the asset will be sold to get some scrap value. That is called residual value. Example, a business purchased a machine for rupees 1 lakh. Estimated life is 10 years. And we estimate that at the end of 10 years, we can be able to sell away the machine for 10,000. So this 10,000 rupees which we fetch at the end of the life of the asset is called scrap value or residual value. Estimated life. So every asset we have to estimate what would be the life. For example, a machine. The machine manufacturer has declared that this machine have an estimated life of 10 years or 15 years. That means even after 15 years it will give the service. But normally we guarantee that this will give the service up to 10 years, up to 15 years. Like this is the estimated life. So these three are the factors which must be considered in order to calculate the depreciation. Now the last topic in this video is methods of providing depreciation. So in examination theory question will be asked, what are the methods of providing depreciation? The first method, most commonly used method is straight line method. This method is also called as fixed installment method. Straight line method, fixed installment method or original cost method means same. So according to this method, the annual depreciation will remain constant. Every year, same amount of depreciation will be charged. Depreciation will not change. So in this case, straight line method, how to calculate depreciation? A fixed percentage may be given. That fixed percentage we apply on the original cost. Example, if the original cost of the machine 1 lakh and 10% is the fixed rate of debt. So 10% of 1 lakh, you will get 10,000. So first year 10,000, second year 10,000, third year 10,000, every year 10,000 rupees depreciation will charge. Secondly, sometimes percentage will not be given. The cost of the asset is given, residual value, scrap value is given, estimated life is given. In that case, annual depreciation is equal to cost minus scrap divided by life. This formula will get to get the annual depreciation. The first method completed straight line. Second method is reducing balance method. This reducing balance method is also called diminishing method or written down value method. Other names. The other names of reducing balance method is diminishing balance method or written down value method. Under this method, the depreciation charged is a fixed rate on the reducing balance. So every year depreciation will decrease. In straight line method, every year the amount of depreciation will be same. But in reducing balance method, every year depreciation will decrease. So in this method, a fixed percentage will be applied on the reducing balance. Example, the machine cost 1 lakh rupees and depreciation is charged at 10% on reducing balance method. The first year, 1 lakh into 10,000 into 10%. 1 lakh into 10%, you will get 10,000. The first year depreciation 10,000. What is the written down value for the second year? 1 lakh rupees minus 10,000. You will get 90,000. The second year WDV is 90,000. On 90,000 calculate 10%. The 10% of 90,000, 9,000. That means first year depreciation 10,000, second year depreciation 9,000. From 90,000 deduct 9,000, 81,000. So 81,000 is the WDV for the third year. Now 81,000 into 10%, 8,100. The depreciation for the third year is 8,100. So first year depreciation 10,000, second year depreciation 9,000, third year depreciation 8,100. Like this diminish. Every year depreciation will decrease because a fixed percentage is calculated on written down value method. Written down value means original cost minus debt. So this is called reducing balance. So two methods I have explained, straight line and reducing balance. The third method is sum of years digits method. Sum of years digits method. In this method also, the annual depreciation will decrease every year. First year more depreciation, second year slightly less, third year again less. Like this, every year depreciation will decrease. So how to calculate depreciation? By taking an example, I am explaining you. Suppose the life of the asset is 3 years. So we add the digits. First year plus second year plus third year. 1 plus 2 plus 3. That is equal to 6. The total of the digits is 6. Now we take the denominator 6. And numerator will take from the reverse order. That means forward order is 1, 2, 3. Backward is 3, 2, 1. So in reverse order we take. The first year depreciation 3 by 6. Second year depreciation 2 by 6. Third year depreciation 1 by 6. Like this we calculate depreciation according to sum of years digits method. Next, annuity method. According to this annuity method, the purchase of asset is treated as an investment. The purchase of asset is treated as an investment. So investment will generate interest. So we calculate interest on the investment of fixed asset. And that interest will be added to the cost of the asset. Interest is added to the cost of the asset. Now we are having actual cost plus interest. On this combined value, we calculate depreciation. That is called annuity method. So annual depreciation, how to calculate? By referring to annuity table. By referring annuity table, we can find out how much is the depreciation. The only difference, the investment in fixed asset is treated as an investment, and investment will earn some interest. So we calculate interest and add to the cost of the asset. Next one is depreciation fund method. This method normally will be used for replacing the old asset by a new asset. That means after the expiry of the life of the asset will become useless. Now we have to replace the asset by a new asset, by purchasing a new asset. So if the intention is to provide the funds for replacement of new asset, we apply depreciation fund method. So what is this depreciation fund method? Every year an amount equal to the investment in asset will be invested in a separate security. The amount of depreciation will be invested in outside marketable securities. Example, 1 lakh rupees is the cost of the machine. 1 lakh rupees is the cost of the machine. The depreciation first year is 10,000. So first year 10,000 rupees investment we purchase. And whatever interest we get, that will also be invested. So all these investments we will make throughout the life of the asset. At the end of the life of the asset, we sell away all the investments, realize the cash and purchase a new asset. So here under this method, the amount written off as depreciation is kept aside and invested in readily available securities like shares. Every year, whatever is the amount of depreciation, that much amount is invested in shares. And the interest received is reinvested. And the securities accumulate, and when the life of the asset expires, the securities are sold and a new asset is purchased. So every year investments are purchased. Even the interest received will also be reinvested. So all these investments will accumulate. At the end of the life of the asset, all the securities will be sold and a new asset will be purchased. The amount to be kept aside as depreciation is calculated on the basis of sinking fund table. So one table is there. By referring to sinking fund table, we have to find out how much is the depreciation, and the amount equal to the depreciation will be invested in securities. Next is insurance policy method. This insurance policy method is also similar to depreciation fund method. The only difference is instead of making the investment ourselves, we take an insurance policy. We approach insurance company and tell that we want a policy for this machine. The life of the machine is 10 years. So after 10 years, we want 1 lakh rupees for replacement of this machine. The insurance company will calculate and say that every year you pay so much amount as premium. So the company will pay every year premium. That amount is equal to the depreciation. So whatever depreciation is, that much amount we are paying the premium. At the end of the life of the asset, the insurance company will pay 1 lakh rupees. From that, a new machine will be purchased. So the only difference between depreciation fund and insurance policy method, in depreciation fund method, company itself will make the investment. In insurance policy method, the investment will be made by the insurance company. Next is revaluation method. This is also one of the method of depreciation where we revalue the value of the asset at the end of each year. For example, at the beginning of the year, the value of the machine was 1 lakh. We have used the machine for 1 year. At the end of the year, we have calculated, revalued how much would be the realizable value of this asset. So at the end of the year, we found that the value of the asset is 80,000. The beginning of the year, the machine value was 1 lakh. At the end of the year, we have calculated the fair value. What is the market value or what is the fair value? It comes to 80,000. So whatever decrease in the value of the asset, that is called depreciation according to revaluation method. Next one is depletion method. Depletion method is a method which is applied for wasting assets or natural resources like coal mines, oil fields, stone quarries. From these things, natural resources are extracted. That means the cost of the asset will be divided. The cost of the asset will be divided in so and so number of years regarding how much material we have extracted, how much coal we have extracted, how much oil we have extracted, like that. Last one is machine hour rate method. Actually, machine hour rate method is a method of depreciation which is applied only for machines. In some machines, the life of the asset is not given in years. It will be given in hours. For example, a machine. A machine we have purchased for rupees 1 lakh, cost of the machine. And the manufacturer of the machine has given the life, estimated life as 1 lakh hours. So 1 lakh rupees is the cost, 1 lakh hours is the life of the machine. Now we divide 1 lakh rupees cost divided by 1 lakh hours, 1 rupee. And for every 1 hour, if for every 1 hour of usage of the machine, 1 rupee is the depreciation. This is the rate of depreciation. Now we find out how many hours the machine was used during a particular year. Example, during a particular 10,000 hours the machine was used. So 10,000 into 1 is 10,000 rupees depreciation. This is called machine hour rate method. That's all. So in this video, I have explained you about the meaning of the term depreciation, objectives, then causes of depreciation, factors to be considered, and methods of calculating depreciation. Hope you got all the points about depreciation and confident in writing the theory on this topic of depreciation. Inshallah, the next topic in this unit, we will continue in the next video. So if you are satisfied, give a like to the video, share my channel in your group, in your friend circle, so that more students can watch the video and enhance knowledge. Give your comments, subscribe if you have not yet subscribed, and buy the super thanks which is given below the video. Inshallah, we'll continue in the next